Hello everyone, welcome to week 10. This week we'll be covering credit law and guarantees. This is an area of law that has undergone lots of reform in recent years, but fortunately for us, the reforms have generally been designed to clarify the requirements of creditors and lenders, which should hopefully make this topic a bit more straightforward. In this first video, we'll discuss the National Credit Code, which was passed into law in 2010, with further reforms coming in 2013. Core to those reforms is the requirement that people or companies who provide credit in the course of business hold a credit license. This regime enables the government to regulate some of the conditions under which credit is provided, and more importantly, regulate the behaviour of creditors in relation to consumers. The exact obligations imposed on credit licence holders will vary based on their activity. For instance, if they provide credit, and if so what kind, or if they simply offer financial services in relation to credit, for example financial advice. But some of the common obligations include doing everything necessary to ensure that the credit activity is conducted efficiently, honestly and fairly. Efficiently is an interesting term, as it cues us on to ideas about competition from previous weeks, and ideally we want credit providers to be in competition to provide the best terms to consumers. The honesty and fairness requirements are also important, as we'll see throughout this video that the main objectives of this code are to ensure that credit providers are honest in their dealings and treat consumers fairly. Unsurprisingly, license holders are required to comply with the license conditions and other rules. That's pretty self-explanatory, although it is worth noting that this is what gives the code its weight, as providing credit is conditional on having a license, and having the license is conditional on complying with the conditions. Ensuring that representatives of the credit provider are adequately trained is a really important one. The National Credit Code introduces a range of requirements about when and how credit providers deal with consumers, and the kinds of notice and form etc. that are required. So it's critical that representatives are across all those rules. Dispute resolution is also key, and license holders may be required to have both an internal dispute resolution process and be a member of an external resolution scheme. Finally, license holders may be required to have professional indemnity insurance. This is important in scenarios such as the wrongdoing exposed during the 2018 Banking Royal Commission. The damages and fines that the banks were required to pay would have been passed on to consumers in terms of higher fees and interest rates if it weren't for professional indemnity insurance. So what does the NCC apply to? Most importantly, the code applies to people rather than legal entities. Owners corporations are a small exception, but for the most part we're dealing with real people here. Second, it applies to credit contracts for a code purpose, which are for domestic or household purposes or for investment in residential property. And this really gets to the heart of what we're talking about here. Just as the Australian consumer law is designed to protect ordinary people in their dealing with businesses and doesn't extend to dealing between businesses in most cases, the credit code is aimed at protecting everyday people in their personal finances and doesn't try to protect what we would think of as more sophisticated players, businesses and investors and things like that. The other two requirements for the NCC to apply are that the charge is made for providing credit and that credit is provided in the course of business. This distinguishes, say, family members loaning money to one another. One of the more important developments of the NCC is the requirement that credit providers assess the suitability of the product before providing it to the consumer. Pursuant to Section 130, this includes making reasonable inquiries about the consumer's requirements of the loan and their objectives in obtaining credit, as well as their financial situation. Credit providers also need to consider the complexity of the product and the capacity of the consumer to understand the credit contract. Now, this doesn't mean that credit providers need to be trained psychologists, but it does mean that they need to be alert to clear signs that might indicate that the customer doesn't understand the terms of the contract. Taking these factors together, the credit provider must take an assessment under Section 128 as to whether the credit is unsuitable for that person. The NCC also imposes hefty disclosure requirements on credit providers. These are designed to ensure that consumers are fully informed before they enter into a contract. However, as we'll see, these provisions can lead consumers to be drowned in paperwork, potentially obscuring the purpose of the provisions. The credit guide is a requirement under Section 126 of the Act, and the key terms here are that the guide has to disclose the provider's obligation to provide a written copy of their assessment of the consumer's suitability to enter the contract, and it must also clearly state that the provider is prohibited from entering an unsuitable contract. In and of themselves, they don't mean a great deal, but in the event that a consumer is unsuitable but provided with credit anyway, these will form important evidentiary documents. The information statement and key fact sheets will be simpler and aim to provide consumers with critical information, but buried amongst everything else in the loan documents, they can be easy to miss. The creditor also has to provide a pre-contractual statement which includes all of these things. I won't go through them all as they're covered in your study guide, but some of the key disclosures include the default rate and the enforcement expenses, and any commission that the provider might stand to make, as well as any associated mortgages and guarantees. The NCC also made some changes to the way that mortgages operate, and most significantly voids or partially voids some mortgages. Hopefully you're already familiar with how a mortgage works, but just to briefly run through it. A mortgage is a security interest a creditor holds over the debtor's property, and in the event of default, the creditor can claim against the mortgage property to recover the debt. The most common scenario is when you buy a house. The bank gives you a loan and they are granted a mortgage over the home, so if you don't make the repayments, the bank can take back possession of the house and sell it in order to get their money back. Now, this exact process is an important exception to the way that mortgages work under Section 45. Section 45 provides that a mortgage is void if it applies to property that is not yet acquired, but one of the exceptions is where the credit in the contract will be used to acquire the property, for instance in getting a loan to buy a house and the mortgage is over the house. Another interesting one is that a mortgage is void to the extent that it secures an amount exceeding the debtor's liability plus reasonable enforcement expenses. Let's say you own your home outright and it's worth $500,000, and you get a loan for $200,000 and there's a mortgage over the home. The home is worth $500,000, but the loan is only for $200,000, so there's a $300,000 difference minus enforcement expenses, and the mortgage doesn't apply to that $300,000. If a debtor is in default of their loan, the credit provider can't take action, for example claiming against mortgage property, unless the debtor has in fact defaulted, they've been given a notice of the default and 30 days to get up to date with their payments, and after that 30 days they're still in default. Only then can the creditor take action. In practice, enforcement is an expensive option, so creditors, especially larger ones that can afford to wait a little, often won't be sweating on that 30-day period to end so they can take action. But in situations where the creditor does need to act quickly, or is perhaps a little zealous, the 30-day window just gives a little space for the debtor to try and get things back under control. Speaking of space, debtors can seek temporary relief following hardship events like health or unemployment that will affect their ability to repay the debt. It's interesting to have a look at your bank's website and look at the terminology they use. For example, the Commonwealth Bank talks about taking a holiday from your loan and acts as if it's a big favour that they're doing you, but it's actually a requirement that credit providers have these options. Finally, Sections 76 and 77 give the courts wide discretion to grant relief if the contract was unjust, and they can even adjust the rights and obligations of parties to make the transaction more just. This is a pretty radical step, but it just goes to demonstrate that the laws focus on delivering fairness and protection to consumer debtors in what can be a complex area of law and the most significant commercial transaction of many people's lives. That concludes our first video for this week. In the next video, we'll be covering guarantees.